Okay, everybody. Thanks for being here. This is Tuesday, March 1st, 2022. And part of the discussion is going to be very applicable to right now in time. Part of this is going to be a lesson that can be used time and time again. And so where we sit with regard to the markets is we're at a place where volatility is changing. It's going from an area of probably 3/4 strength volatility, not exceptional, but in some areas of the market, it's pretty high volatility. And then it drops in and people get comfortable quickly, especially those in established markets, because quite frankly, there's a bias where people think things in Ukraine and Russia don't affect me. And so volatility comes in. But we're going to walk through some of the issues that are going to pop up over the next 3 to 6 months and why it's important to understand those issues and to be able to look for opportunities. So where there's challenges, there's also opportunities. Where people don't have clarity on where the market is going, there's opportunity for us to buy in at a lower price and sell at a higher price. Where people are overexcited and over-concerned and what have you, there's a chance for us to sell premium and let them calm down. And when they calm down, we make a profit on that. So there are a few different strategies, but the one that we're going to talk about is in that middle space today. We're going to talk about a strategy in options called an iron butterfly. Lots of people trade something called the iron Condor, and it's a very safe premium selling model. This is a little different. It's a little more aggressive, but if you trade it properly, you can yield some pretty nice results and you can take on less measure of risk. So we're going to talk about how to trade the iron Condor, or excuse me, the iron butterfly today. I'll bring up a little graphic. I had one drawn out and I literally, my internet lost and my sheet got lost and I wasn't able to rebuild it quickly enough. So I'm going to use another one and we'll draw on that and go from there. But let's take a step back. Before we get into that, let's talk about where markets are and where things are today. So for months and months, we've been expecting the incursion of Ukraine by Russia. We've been expecting that. I mean, we've talked about it, I think, on these groups. We've certainly talked about it some in the chat room, and I've been discussing it in public forums for at least 2 months. And we know that the likelihood of Russia coming into Ukraine was very high for a number of different reasons. It's a legacy issue. We know that Putin has more money than he will ever be able to spend, and more than many countries could spend in a decade. And so it's not about money. He lost something. The USSR was broken up. He was embarrassed. There are a lot of other things tied to that. And you have a number of stands in other countries like Ukraine that have now gone off and done their own thing. Many of those, as you can imagine, have seen great success. And they said, wow, capital markets, freedom to do what we want, no capitation on what we can do, and the ability to do anything and create a new business excites some people. Some folks that have been raised in the government, being dependent on the government for decades and decades and decades, it's very, very difficult for them to adjust. So you have some parts of the country where they're saying, look, I just want to go back to knowing that I have someone taking care of me when I'm sick and old, and I'm close to or at that point now. You have other areas where there's lots of technology, lots of new things happening in agriculture, and those folks say, look, there's a lot of opportunity for us to do things. We want to have our opportunity to build wealth without a compression of the middle class. And so what ends up happening is you do get a very small middle class, and you actually get an elite class and a growing lower middle income or upper impoverished class is what happens in most places where they support. The more advanced the socialism is, and the closer they move towards communism, the more that middle class gets disparaged. So that's what we've seen in Russia. And that's what we've seen in a lot of the other countries. And many of those who are very dependent on government infrastructure and government aid and what have you, even though the country fell, because of that, they weren't able to support themselves because once you take from everyone and you keep giving to those who are not producing, at some point they get tired of producing themselves and you fold under your own weight. And that's what's happened to most countries as they've gone quickly from socialism into communism, and other groups come in to resolve the issues, or there end up being military coups or one coup after another, and they never get relieved from the poverty that they've walked themselves into, the hole that they've dug. And so we fear for Ukraine for that reason, and we hope that they'll do well. But quite frankly, the math, just so that we're very clear on where markets are likely to go, the math is that they are overwhelmingly the underdog, right? We hope for them, we pray for them, we support them, but they have a fraction of the military power that Russia has. They have a fraction of the staying power that Russia has. Most of the tanks and other forces that have come across, they come in the winter when their tracks will work across the snow and the hard ground. Once the snow starts to melt in about 2 months, and they can't get things, they can't get support in, they can't get gas in, they can't get repairs in, they can't get food in, there may be an opportunity. If they can hold on long enough, Russia will have to retreat and come up with something else and take perhaps the land that it is able to take over, assuming that it's not able to take over all of Ukraine. And it'll have to find another way. My expectation is that it's at least going to take those areas of the country that we're wanting to rejoin, and it may take control of some others, but then the picture may end up looking more like what Ireland did for years, where there's a constant battle, people blowing up buildings and skirmishes and fights and car bombs and things going off as you have this concentrated group who are very passionate about retaining their rights as free capital market citizens fight back. So I don't think that even if they do take over the country, it will be a smooth transition for a long period of time. So that's kind of where those things stand. Other than that, let's understand a couple of other big picture items. The wheat production in Ukraine is one of the top in the world, huge, which is why wheat limit up today, right? Why today? We've been knowing this for months. It's because the reason people were waiting is now there's enough of an incursion where people are dropping their hay forks and their tractors and they're going to guns to support their country. And if they miss the beginning, so it's winter time now, but if they believe that this is going to extend into spring, into planting season, that wheat is going to be dramatically reduced. On top of that, what has been harvested and sits for sale now that hasn't been yet exported may not be exported. So there may be an overflow of product that can't get out of the country. And a lot of folks are not going to be able to manage the trucks and what have you to sell it into the countries where they normally would because of the military being in their way, right? So you can expect a lot of volatility in wheat. If you look at, and we're going to walk through the charts on flow for this, and I think this is where the weekly stuff that a lot of us probably don't use on a daily basis, but this is where, as a former fund manager and a longer term trader and asset manager, this is some stuff that will make your portfolio. Literally, some of the stuff we're going to talk about today could make your year. While a lot of people are going to get crushed, indexes are going to get hurt in many different ways. There may be a big retracement prior to the elections in the US. There's an opportunity to make a boatload of money. And so I'm excited to walk through some of those charts today. And I kind of want to get into them, into some of the indexes so you can see where the strength is. But as we walk through why that happens, China's watching very closely. They're already sharing information, cautioning the US from being involved because they're basically saying, the US was bombing places when it was uncalled for here. They were, they were interfering in this war when they weren't asked to. They were participating here when they weren't asked to. They've seen themselves as the big brother here when they're not the big brother here. And so they're sharing that with their people on a regular basis in an effort to build up this momentum where they may take Taiwan. And because we have a weak government in the United States presently, as far as defense, we have not built up our defense where it really needs to be. We've spent more money than we should have probably on COVID and COVID response. We don't have the dollars, and we don't have the wherewithal, and we don't have the leadership to go and fight wars in foreign countries right now. That being said, there's incredible treasures in places like Ukraine. Tremendous oil and gas production, tremendous wheat and other natural resource production. And in China, the same thing with Taiwan. One of the hedges against all of the production in electronics, as well as many other food commodities, Taiwan has been the place that kept some of those prices from going too high and made sure that production was of higher quality. So a lot of things produced in China are then going to Taiwan and they're added in or built in, and some of the production quality increases by going through Taiwan. If Taiwan is taken over, you can expect prices to go up, production volumes to go down, and then that is made worse by something else. China is having trouble paying its debts right now, and where a lot of people, when they get backed into a corner, they sell the big house and they budget. right? They say, we got to move to a smaller place. We got to sell the fancy car and buy a smaller car. Other countries react like cats, right? They react like a tiger in a corner. And when they get stuck, they reach out for other people and they try to grab some new opportunity for two or three reasons. One is to deflect from their problems that they have now. We see that in people, right? We know people that when they get into a corner, instead of focusing and concentrating what they need to do better, they they lash out at other people, right? Countries are the same way. In fact, there's cultures that are built into that model. And we saw that in World War II, and I've shared that before. One of the reasons Japan was going after other countries was because Japan was in financial straits and needed to do something to acquire new land, new opportunity, products to sell, and what have you. And so they were going wherever they could with the last bits of dollars that they had. And we're now seeing that with China. And so China is having trouble in the business that I'm in. I'm hearing of companies who are not being paid for the grains that they've sold to them, that they're not being, the payment systems are being changed up so that they're not as secure as they used to be. And of course, we know about other companies that Evergrande and others that have gone bankrupt, losing tens of billions of dollars for investors, and many of those investors coming from the US and Europe. But that failure has been effectuated by the leadership in China. So we're setting a standard now in Ukraine, saying we're not going to help much there. We're late to the party. We're way behind. We're sending support after the war is already half over, and that's telling China that they could probably do the same thing in Taiwan. Oh, it's also telling North Korea they can probably, this may be the time if they're going to reach out and buy a lottery ticket to attack other areas. This may be the time for North Korea as well, right? So anybody that thinks that they have a shot at it, at the title, right? If you want to get in the ring, if you want to go and go at it, this may be the time to do it, because you have the US largely unable to support and unwilling to support. You have Europe kind of in its own internal battles and financially drained because of COVID and what have you. So there's not a lot of folks to come to the aid of those countries should they be attacked. So what does this mean? It means that commodity prices around the world are going to go up, but it also means that in some areas, there's going to be exceptional volatility. I'll give you an example. Many of you guys who follow, that are traders on the Trade Oracle platform, and you're in the chat room, and you follow our senior trader, Mills Rooks. As you folks know, Mills was led the department for Merrill Lynch for many, many years in commodities, and especially in food commodities, and being based in the South. He still watches soybean and corn and wheat and sugar and rice and all those things on a regular basis. It's in his blood. And many of you that have been following for a while know that he made an incredible call in soybeans. He makes these seasonal calls every once in a while. And quite frankly, as long as I've known him, for maybe almost 3 decades now, I don't know that he's ever had a bad call on his longer term, on his midterm to long-term outlooks. When he sees something, when he sees an opportunity, typically those 3 month to 6 month calls are pretty darn accurate. And so one of those that I'll mention today, because it's his call, not mine, but when I research it, I absolutely agree with him, is wheat. And I think corn and some of these others are all going to have the same impact. So we've seen a big jump in things, and they will probably continue to go through the blue lines because it's caused by an exceptional event. But when they turn and they come back and everyone's bought, one of the what causes a market to crash is not because you have lots of sellers, it's because you don't have any buyers, right? You can hold a market up if there's lots of buyers. You can have lots of sellers and the volume increases. That's why volume increases on momentum up. It's not just because people are buying, because it could drive the price straight up. It's because people are selling and people are buying, people are selling, and you have to have someone on both sides of the trade. But what happens to cause markets to drop precipitously over a short period of time is that the buyers go away. People are not willing to buy it at that price, and they leave. They quit shopping. And that is likely going to happen for a period of time, for a short period, until people regather their senses. And this kind of thing happened in the cattle industry, right? During COVID, people were literally, prices were like $1, $2 below production. farmers are not going to sell. They'll just hold them, right? They'll put them out to pasture. They'll take them out of the feed lot where it cost them, 80 cents to $1.90 a day to keep that cow. They'll take them and haul them back to a pasture for a month or two before they sell it at kind of a loss. So when prices drop down to that point, at some point they actually got negative in some areas. We've even seen energy sometimes go negative. There's no way that lasts very long, right? So then it has an explosive move back the other way. Well, those kinds of things are very likely going to happen in food commodities. Maize, soy, wheat, sorghum, rice, and sugar are the ones to watch. Maize, soy, wheat, rice, and sugar. So those are kind of the big five to pay attention to right now. The other thing that will likely happen is in some of the metals. Metals are seen as a security mechanism, right? So those of you who are watching gold today saw it explode, and it did really, really well. And that actually led to why I'm going to share this other strategy with you. And so prices will go way up, but as soon as people get comfortable, then the prices will come back in and they'll drop in a little bit. But for the next several weeks, we're going to look at gold, and you're going to be amazed at where the projections are for gold to go. And but the volatility that comes with that creates huge opportunity. A lot of people are going to get scared out of it, and it's going to mean that some of you that are scalpers are going to need to keep really tight stops, but look for those short-term explosive moves. And you may go from making 3 out of 4 winning trades to making 1 out of 3 winning trades, but you get stopped out, but your winners are huge. And we're going to have to tweak the way that we trade a little bit to make sure that we're effective over the next 60 or 90 days. So we've kind of seen this thing coming, but I want to make sure that we're prepared for it. So in the area of gold and silver, those are the kind of things that we're going to see people buying and selling for protection. But the other area is supply. And one of the key supply areas, again, it's a space that mills and those of you who follow the slingshot signals see, is copper. And copper has extraordinary moves, sometimes inside of a single day, sometimes that they last for several days. But copper, again, going back to what we had talked about earlier, is that Zambia is the largest producer of copper in the world. China is the largest buyer of copper in the world. Well, Zambia is almost bankrupt themselves, having difficulty paying bills, signing on to borrow from other places, including places like China, who are going to take over their country, take over rights and privileges, free import, free export, things like that, and slowly build a stronger base than they already have, which is pretty exceptional already, into countries like Zambia, because those countries are having trouble paying their own debts. They're indebting themselves just like the US. We're not the only ones that wrote way more. We spent tons of money trying to get out of COVID. Other countries followed along and did the same thing. They just don't have the capacity to bring in new income from new business and raise taxes and see the effect of that as efficiently as countries like the US and some of the European countries. So in China now is unable to sell things, unable to ship things, unable to produce things, and they need to be able to buy stuff like copper. But now you have countries that are unable to sell the copper to them because Chinese are not able to pay the debt either. So it's kind of borrowing, it's a bum borrowing from a bum. And not to disparage either of those countries, but the analogy is simple, right? They're both trying to find a way to get something for free or create a business or what have you, but it's just not going to work between the two. So it means that China is going to have to find new ways to sell things and new ways to find resources and new ways to create credit that it didn't really have. And I think some of that, my belief is that some of that's going to come from rewriting the debt that those countries have. We'll sell you this, but instead of you paying us, the problem is if you are a country that owes a lot of money to China, what do you think the natural response would be? The natural response would be, look, we owe you $1 billion and you want to buy $1.5 billion worth of copper. How about we'll give you $1.5 billion and you only pay us $500 million and we'll write off our debt. Now we don't owe you anything more, right? That's what you'd normally say. The problem is the countries that are selling that $1.5 billion don't have, they need every penny of that. So it puts them in a very precarious position. So what likely will happen is intermediation. You'll have other countries and other banks that will come in and say, we will restructure that debt. And you now sell $1.5 billion for $1 billion, and then we'll restructure the other $500 million for you. And there'll be things like that going on in many countries. But as you can imagine, there's more than 100 countries in that position, more than 100. So those countries are all going to groups like the IMF and the World Bank and the development banks and what have you, trying to find out ways that they can restructure, but they're trying to do it quickly enough that they can get the supplies, seeds and fertilizers and other things in time for the coming season so that their farmers can plant and the food aid can come in. People can't go for 6 months or 9 months, which is normally what it takes, 9 to 12 months to restructure these things. They can't go that long without food. And they certainly can't go that long because 9 months covers 2 seasons. They certainly can't go without planting their crops for 2 seasons. They won't be farmers anymore. They'll lose their farms. They won't be able to feed their families. It will be a global catastrophe. So everyone's not going to solve their problem. That's something to consider. That's the follow-on wave of impact from everything that's happened over the past few years. That comes from not being prepared in advance. It comes from poor leadership in many, many, many countries. And it comes from a model of when we need money, we print it versus we save it. And since countries don't enable themselves to do that, very few, there are some, but very few do that. It's now going to create a wave of global mini catastrophes at the very minimum. So I'm going to take all that, and it doesn't need to necessarily be negative because we will get through it somehow. It won't be pretty, right? It won't be pretty, but we will get through it. One way or the other, we'll get through it. And all the countries will figure out something. And many of those who have been stressed and in this kind of position time and time again, they're probably better at it because they've been in this many, many times, right? It's the one that doesn't know how to handle it. And I'm constantly reminded of that when I go to developing markets and I'm running through the rivers or out in the fields and I see people that are traveling, they touch their mouth or they do whatever and they get something in from the water and they are just torn up for the next several days. Their intestines are falling out and their head's aching and they're throwing up and what have you. In the meantime, there's children in the water playing around and splashing and drinking right out of the river and they're fine. It's because they grew up in it. They have the worms, they have the parasites, they're used to the bacteria and their body's actually adjusted. So if you wanted somebody to go run 10 miles to solve a problem, that 10-year-old's probably a better solution than somebody like me or someone else because I'm not prepared for it and they are. And so these countries will get through it and they'll find unique ways to solve those problems. But let's roll that back into the marketplace. How can we, understanding that those things are going to happen and they're not all going to happen at the same time and different countries have different production. Most of the people that trade or that may watch this may not be commodity traders. They may be futures traders trading indexes and what have you, but maybe not so much in the space of food. But I want to open up your mind to looking at some of those because they can provide some opportunity. The other is that many of these things that we used to trade as commodities only actually have ETFs now. So this is a great time to readjust your 401k, your IRA, and any other retirement accounts. And you can buy me a Diet Coke or an iced tea. I like it half sweet, half unsweet. You can, when we meet. And if this works out for you in the way that it should, right? So I'd be remiss if I didn't walk through some of these things just to let you know. So I'm going to switch over to a Word doc, and we're going to draw a couple of things out here. So hopefully you can see that. And this is, I'm calling it the market outlook because that really is what that's really what we were talking about right now. And it's all led by volatility. And I want to make sure that we kind of share, from an options perspective, there's two different kinds there's actually multiple, but we want to talk about implied volatility. We write these up as we go. Implied volatility and I want to talk about Vega, but I want to do it separately. So we'll talk about volatility, and then I'll add Vega at the end. So implied volatility, really, if you think about from an options perspective, and it's important to when we discuss this in the chat room, it's important to understand. So implied volatility is really just the price of an option, right? So the option has many, many things. There's several Greeks. There's 6 to 8 primary Greeks that people look at. And each of those Greeks just describes a different type of mathematical assessment or analysis of that particular underlying asset or of a derivative of that asset. And a derivative could be an options contract, a futures contract, or an options on a futures contract. Those are the three primary derivatives. Now, typically, when we talk about stocks, we have stocks and options. In indexes, we have options on indexes, and now we have futures on indexes and options on futures on indexes. And we have the same thing in commodities, right? So we have commodity futures, and then we have options on those futures as well. Implied volatility, if you have something that is at its, so the price of the commodity or stock or index or currency or crypto, I'm going to add crypto in there. That is the underlying. Right. So when we talk about the underlying, that's the underlying value of that stock or commodity. So if Intel's trading at $100, it's $100 is the underlying. If the option is 95 strike price, the strike price is the price at which you're contracting to buy or sell. And so 95 is at below or above. If it's below, then you have something else added on top of that, right? You're paying someone for the option to buy. You have an underlying value. It's already in the money, ITM in the money. It's worth something. And then anything over that is you're paying for the time of that contract. And the time of that contract can be looked at in a few different ways as well, right? If you have 30 days versus 90 days versus 120 days, there's the amount of money that you're not able to use for that period of time, but there's what else? There's also the expected volatility. If you have a home 5 years ago when prices were only moving up 2 or 3% maybe a year, and you were selling a contract, the difference between giving someone 90 days to buy it or 180 days to buy it, there wasn't a very big difference because you knew kind of what the difference was. So you may raise it 1%. So if they paid $10 for an option, it was $10, and 3 months later, maybe $11 or $12, right? But now prices are going up 15. I just heard today in Colorado, home prices are expected to go up another 16% in the next 12 months, 16%. So if I'm going to give someone a contract, an option to buy my home, and I'm going to extend it out 12 months, how much do you think I'm going to charge for that premium? I certainly don't want to sell something for $100 that I know is likely going to be worth 116 and just sell it to them for 105. I'm going to make it 120, right? I'm going to build in the expected price increase into that. And that price increase is part of the packaging of implied volatility. And so implied volatility is the price of the option that incorporates kind of all of that. We talk about theta, which is time value. But the other one that's related to this is vega. And vega is really is the sensitivity of the option to implied volatility, right? So it basically means that if Coca-Cola goes up $5, it's $50 and goes up 5, the option price may go up 20 cents. It may go up 50 cents. But if Tesla goes up 50 cents or the same percentage wise, it may actually, the volatility may be higher because Tesla is so violent, or it may increase. If it breaks through a certain level, it may go higher. So vega is similar to what we would call in the underlying world. When we talk about stocks, we talk about beta, the ability for, if the market goes up 1%, the stock goes up half. That means it has a beta of 0.5. If the market goes up 1 and it goes up $1 or 1%, and it goes up 2%, it has a beta of 2, right? So we typically trade things that have higher betas because we want to be able to see the market start going. And we know that where the things that are really going to move, where we can make the most percentage on our money, are those things that move more actively than that base market. And so we look for things that typically have a high beta, 2, 4, 6, sometimes even higher than that. In options trading, we look for vega. We're looking for things that are very sensitive to changes in prices. And we're also looking for higher implied volatility. So something can be sensitive, but it doesn't change very much. But most often, if you have high implied volatility, you have higher vega. When you have higher vega, you have higher implied volatility. They are a little different. One is the actual price of the underlying, the implied volatility built into the price of the option. The other is the sensitivity of that price moving up and down, how much it varies according to the underlying value. Both of those build in, and we aggregate them. Oftentimes we talk about volatility or vol. And so while you'll see this sometimes abbreviated as IVOL, is implied volatility. And you'll see sometimes people call this V for Vega, or you'll just see it capitalized Vega. When you see people saying they're buying or selling vol, that is, and we try to capitalize it, by the way, if because a lot of other times we're talking about it's volume, right? So if you're a buyer of volatility, it's kind of implying both of those. And in this time, in this particular period at the beginning of March and for the next few months, we're in an area where volatility is bouncing up. It's not in the low range, it's not in the super high range, but it's actually bouncing around. And so what we're looking at is, again, one of the things that we also, you've heard me say many, many times, is another Greek term, is called delta. And that's done by the symbol of a triangle. You'll see this triangle symbol sometimes, but you'll also hear that said. And delta is where we say, in the computer world, we say that data is critically important. And I speak to the people in our software company and in our data aggregation companies. We say that data is important, but delta is more important. It's not the data, it's the delta, right? It's not where the data says things are right now. It's not what the price of Intel is. It's where does it come from and where is it going? That's what's really important. If it's here, but it goes back and forth like this for months and months, no matter what the rest of the market does, that delta, is telling us that it doesn't move a whole heck of a lot. So delta is actually the change in the price of the underlying asset, right? So, and we can look at that in a few different ways. So we see, and so we typically look at that as a trader from percentage. If you're looking at small stocks, you're trading something that's going from $1.05 to $1.07, you can say, well, that's a 2% jump. That's pretty big percentage wise. You have to trade lots of shares to be able to do that. People that trade penny stocks, that's one of the reasons they do that. Percentage wise, they can make huge money. Stuff can go from $1.50 to $1.85 in an hour, and you can make really, really big returns. But there are a lot of other factors, obviously, that tie into that. What's the average daily volume of something like that? Are there any options? How do you hedge it? Can you short it? There's all sorts of things that come in with those. But delta in general means just the change in the price of the underlying. So we're looking for things that have gotten to a low delta for right now, but they have an implied volatility the picture that I'd like to paint for you is where people are getting on the edge of their seats. If you're watching something and you find that wow, gold is going to take off. I don't know whether it's going to fall apart or it's going to rock and roll, but it's going to change. That's implied volatility. That means that it's got that value built in because everyone's adding a little bit of premium because they know it's going to do something, and the premium goes up a little bit. But when all of a sudden that vol really happens and it either falls apart or it goes up, the implied volatility goes up more because of the directional move, right? So the actual pricing of the underlying goes way up. And the Vega, it was there, it goes up as well. So if you buy something that's been bouncing around and now it's settling down a little bit, but it's catching its breath and it's going to take off again, that's a great buying opportunity. And where we normally see that is in a triangle formation, right? So I'll try to draw very quickly here. So when we see the price coming into this space, and you see that triangle, where the price action has done this, and it's been really wide, and then it's narrowing a little, and then it's going up, and then it's narrowing a little bit. And you see it, and at some point it's either going to break out, it's either going to rip to the upside, or it's going to fall apart. It's not going to stay here, right? Those are great, great opportunities to trade. And if you may be a trader waiting on it to break back above this level. You may be a trader waiting on it to go below this level, and you're going to buy it or you're going to sell it. You're going to short it, right? But there's also another thing that you can do. And right now, I do want to tell you, if you are a trader, we want to pick out where these levels are. Sometimes the level is here, and literally at the edge of the triangle. Sometimes it's actually a level above. Other times it'll go to this resistance level and it'll pop up, then it'll come back into here. So you can create those bands. And we know that, we see that from trading regularly. But when there's also expected things going on, like the Fed is meeting next week and the price is going like this. Russia is getting ready to invade Ukraine and the price is going like this. When debt is being restructured from a country, when someone's looking at leaving, they're exiting they're through a Brexit type situation. They're Turkey or Greece or Italy or one of these others is looking at changing their currency structure, and you see related items doing this. Those are opportunities. If you're an options trader, you would say, what? I'd like to buy a call and a put, because I don't know which way it's going to go. I don't know whether they're going to sign a peace agreement or they're going to invade. I don't know whether they're going to leave. It's going to be a Brexit or an influx, and they're going to restructure their debt, right? These are times where you can buy a call and a put at the same time. And by buying a call and a put, what does that mean? Normally it has to go past here for you to make money. Well, if you bought both sides, now it has to go up here. So you need to make sometimes, typically it's not double, but it's typically 1.5 or so times. It needs to go at least that far before you're break even, because you've got to pay for both sides, right? You got to pay for both. You bought both options. So it doesn't just have to get past what you paid for the option. It has to get past that plus what you paid for the other option. That's the risk in buying what's called a straddle, buying a call and buying a put. It's also the reason sometimes people sell straddles. So what some people do is they go, well, it's going to move up a lot, but I don't know which place. And I know that there's a resistance level up here and a resistance level there. That's when we actually go long that way. And then we come to the top and we sell something. And so we come way out here. So we buy a put option and then we sell a put option way down here. We buy a call and we sell a call. And normally what's going to happen is if you spent, say, $10 on this, you might be able to recoup $5 by selling these. So now you're only out $5 instead of 10 in risk. You do put a capitation on how much money you can make, but you also put reduced what your risk is in half. And there's actually some other trades that you can make, right? If you know it's likely going to go up here and then fall, you can actually take it, sell one side of the trade and let it come back, and you pick up even more money as it retraces. So we'll talk a little bit about that, but I'm going to use this chart to explain it a little bit. Hopefully this is large enough where you can see. And when we talk about strikes, we're talking about is the strike price is the price at which you buy or sell an option, right? We're going to be looking at those that are at the money. So in the money is something that's below where the price is actually trading now. Out of the money, and OTM is away from where it's trading at right now. And so at the money is where we're going to talk about putting this on. That's where really a straddle is. It means buying a call and buying a put, basically where the price is right now, or in the middle. If it's going back and forth, and it's going 1900, 1905 to 1895, 1900 to the middle. It may be 1905, but you're buying a 1900 call and selling a 1900 put, or buying a 1900 call and buying a 1900 put, excuse me, because that's kind of the middle of that triangle. That's where you see everything coming together. So here, that middle line is the security price. And if we turn around and we buy a call option and we buy a put option, then what ends up happening is that we can make as much money as we can literally go to the moon either way. So in the instance of gold today, and I'll roll this, I'm going to come back to this, but I'm going to roll it up a little bit. So in the instance of gold today, and I put this trade on a little bit earlier. We'll put a couple of these and we'll add. So I bought at 1900 call and a 1900 put. And together, I spent about $75 on that. And those were So it's March 1st, and those expired in around April 22. So they had about 40 some odd days to expiry. So I had a good amount of time, but I'm paying for that, right? I'm paying for that ability to have that much time in something that trades fairly actively and can be fairly volatile, like gold. And so I bought it at 75, but when I was able to, but knowing that there was going to be an explosive move, we just come from that triangle down and triangle up. I have essentially $37, $38 either way. And so what ends up happening, and this is an enigma of the markets, and this is why I want to share it with you. So they were pretty close to the same price. Move these in a little bit. They're pretty close. So for example, the call was around $40, and the put was around $35. So they weren't exactly right. The puts were lower priced than the calls, but anyway. And why do you think that is? Let's take a quick step back. Why do you think the calls are higher priced than the put? So if I bought it at the same price, at the money, why would it be higher? Well, there are a few different reasons, but I'm going to break it down into the very basics. The real reason is there are math models behind it, giving implied volatility and the risk of things going up versus the risk of going down. A put can only go to zero, and a call option theoretically can go forever, right? So if you sold a call versus selling a put, I can only lose $35 times however many shares I sold on a put. On a call, I could go to 40,000, right? I could lose everything. So there's typically a little bit more of a premium in a call. So that's one that's consistent across everything. But the other is there's actually math models that are kind of suggesting that the call is going to be higher than the others. And we're not going to get into it now, but I have friends, and maybe I'll bring him on as an interview, but I have a friend who made billions of dollars trading what's called the Black-Scholes model, which is the standard for people that trade options around the world, but it's not 100% efficient. And this is part of the reason it's not efficient, because we don't price things necessarily equally for call and put based on price volatility, because we add in these other underlying issues that don't really necessarily have value. It's not likely that gold's going to go to zero. It's, and it's not likely that gold's going to go to 20,000 or to 35,000 or what have you in 20 days either. So those risks are so many decimal points deep in a risk metric or a risk matrix that they're really not valuable. But because they do exist, there's a little premium added. So anyway, let's get back to the pricing. So $40 on one side, 35 on the other. Well, and this is why we talk about the rate of change. As things approach a target, prices change respectively. So what happens normally when we do options pricing, and we will do this, and I'm hoping that when we do our live class, we'll actually walk through, and I'll take you through a whole series. I have an options book that I wrote many, many years ago, and I'll walk through that options manual and show you real time how some of that stuff works as well. But we often look at, here's what I can make, here's what I can lose, and here's the math model of what that looks like, very similar to what you see at the top. But what we don't pay attention to is that things are dynamic and that they move. And so as they approach one area, some things change. So as gold actually went, I think it actually went to 1948 or so. And our target was, I had 1900, and it went to 1948. The call option, let me put this. Call option, as it approached that, went from $40. It went up to, I'm trying to remember what it was. Went up 30, it went to, I think, 79. Let's just say 79 from 40. So if it went up $39, let me draw this one. And the 35, if you bought a put and it goes against you, it's dropping, right? So it dropped in value. And so where it was trading at 35 and it went $30 against it, it dropped to around 15. Okay. So let me go back to my normal, let me just use a black pen. So this is equal to what kind of gain? So it started at 40, it went to plus, so it went up 39, right? It went up 39, while this one dropped from 35 to 15 and went down 20, right? So it does drop. But what's interesting is that because you're adding to the implied volatility, and implied volatility is also enhanced by outside markets, people getting caught up in buying. And so not only does it just go up that amount, it actually goes up more as people get scared, as people get opportunistic. And so it adds more value sometimes than it ought to, but it literally went up $39. And then the put option was all based on time value anyway. So while the time value didn't really change but one day, the distance from the strike price changed. And so it's fairly pure. Because it has that pure metric to it, it dropped 20. Well, now you make $39 on one side and you lose $20 on the other. You just made $19, right, per contract. And actually here, the net today was actually a little over $9. But that's big. You know, on 10 contracts, that was $9,000 on a small trade. It can be pretty sizable. And so what you want to do then is you say $19. And actually, let me adjust that because it was actually, let me say it was, I'm going to go back and fix this to give you the actual numbers. So this was 25 and this dropped 10. Or this dropped, so that would be, 10. Was that right? Excuse me. Went to 0. So it dropped to 29. Oh, excuse me. I'm getting all this wrong. The bottom line is it ended up at 9. It made $9. Well, $9, the reason I wanted to share that with you is that's $9 on 70, on 75. So you had $75 theoretically at risk, and you can't really risk 75, right? Because if you're buying a call and a put, they're not going to both expire worthless unless it's sitting at 75. So if it goes up $10, you know, you'd make $10 on one side or $10 on the other, or whatever the case may be. So the likelihood that it's going to risk most of it is very, very unlikely. So if you're making 1/8, 1/7, you know, here you're making 10+% in a day on the money at risk, right? 10 or 12% is a pretty darn good daily gain, you know. So this is 10 plus. This is actually, you know, 12% or so. So you're 11+% on that to be conservative. And if you're able to do 10% on that on a regular basis, that's pretty good. But where this really, really works well is when you have that medium area of volatility where prices are ready to explode. You don't know which way it's going to go. And so you buy both sides. And it's good to see where things flatten out. And if you want to see it a couple of days before, so when you see one big move up, one big move down, and it retraces, and you know it's getting ready to set into a triangle pattern, then you wait for the next move or two, and we'll talk about when that changes. I'll go down and draw a picture of that. When do you actually buy? When does the volatility start to drop in? That's when you can put this trade on at the least cost and have the biggest return. So I'll clean these numbers up, but the so if this dropped to 5, you lost 30. You lost 30, right? And you made 9. So that's where that kind of comes to. So let's roll it down a little bit, and I'm going to show you the chart, the triangle pattern, and then I want to go to actual charts. We'll finish from there. See if I can scroll down. There we go. So we have, I'll print this out for you guys, or I'll share this with you as well. So you have the strike price of where the security is. You have the maximum amount of losses, what you paid for it, right? So the maximum amount of put is what you paid for the put and the strike price. So if you paid $30 and from where it is, it's got to go down at least $30, whatever is in between that. From if it drops 10, you only lose 20. You know, if it drops 20, you lose 10, and so on and so forth. If you, and that's assuming you exercise it before, or you sell it, close it out before the due date. When the exercise date comes, it goes to zero if it doesn't meet that number. And so anything from where you are is to there. So if you're selling it, you lose it. If you're buying that straddle, you make whatever dollars it goes. If it goes $5, you make 5, 10, 20. If you paid 30, you still lose money, but not as much, right? Same thing on the call side. If you bought it for $30 and it goes up 20, you made $20 on it when it closed, but you lost the other 15. So you bring some of that back. If you buy both sides, you're only going to make money typically on one side, with the exception of one strategy. And in options, we call it trading around the post. But you can also do the same thing here. If you see the price go to 79, you can actually sell one side of it. Why would you sell your puts? If you bought them, you don't necessarily need to sell them, right? So the reason that you would sell both at the same time, if you're a level 1 or a level 2 trader, is to lock in your $9, because this dropped to 5, but it could go to 0. That's the reason you would sell it, is because if gold keeps going and keeps going and keeps going, for example, today it went from even, up, it went from 1900 or whatever to 1942. I sold mine when it was priced around 42 and went all the way up to 48. And that was in the last hour or so. And I had things to do, and I locked it in, left some money on the table, but you never go broke taking a profit. At the same time, if I had sold only the calls and it kept on going another $6, this 0.5 might have dropped to 0.2, and I'd have lost $3,000 on the decline, and I would have had to wait till it comes all the way back down. If you are, when you get to a place where you're comfortable and you see things moving around, you may want to do that. You'll sell one side, but then maybe you write something higher, or you buy a put at another strike price to protect it, so that you lock in part of that gain, but you protect yourself from it going too far against you. And so you create a new position. You go from going both ways to now, if you're now short, you say, well, I'm far out from short. So then you can either sell something further out, which you're not going to get much money for, or you can sell another call spread if you think it's going down. There are things you can do to add in more premium and still hold on to that trade. And we'll talk about that at another time. But right now, the simple model is you can bet on it going both ways. And if it jumps, it'll typically, in the move that it goes, this went, this was 80% of the distance that I thought it would go. And that'll oftentimes work. So if I paid $35 per side, say 40 plus 30, 37.50, right? And it actually went to 39, and I lost some on the other side, but because there's still some value in the other side, you can make a nice spread on that. So if it goes 80% of the distance, you can typically make 10 or 12% of what it is. And so, and when I say that distance, how do you select what that distance is? Well, you base it on prior volatility, and we're going to walk through that on another call. We'll actually walk through a specific strategy and see where we price it, and we'll walk through it. So I'll probably do that, a similar trade like that this coming week. I'll show you how I enter it. I'll print it out, and then we'll show you how we exit it on Wednesday or Thursday, a couple of days later. But the point of it is that it goes up in a dynamic fashion. It doesn't necessarily go dollar for dollar, but it goes pretty close. Sometimes it goes even more. And so when this went up $40, the strike went up 39, but the put, the other side of it, didn't drop that much. It didn't have that much to drop, and it's still time value. So it lost time value, but it didn't add implied value like the other side. So this is an area where implied value is adding to your side if you're on the winning side. And if you own both sides, you will be on the winning side on one of those. So you're adding implied value through that implied volatility. And because the volatility is increasing, it's breaking out of that triangle. There's extra premium sometimes being built into that because of the risk that other people see in taking that contract on. And you're selling that risk. You're selling insurance to those folks. And that's why insurance companies have big buildings all over the world, right? Because they're selling premium that most people don't die every year. Most people only die once. And we have good models to, they're selling things basically telling you that most people are going to die at 76 when most people are going to live to be 92, and they make the difference. They make the spread on that. We can kind of do the same thing. There's an extra premium added for taking the risk. Wherever you can make that, you can make it. Typically, and this is the important thing to think of, we hear from folks all the time, be a seller of insurance, make money by selling insurance. So we think of that as selling calls and selling puts. This is an instance where you're buying what you know is going to go up in value. It's like buying insurance for volatility, and then you're selling that insurance at a higher price. So you are selling the insurance at a higher price, but you're buying it when the cost has come down, knowing that things are going to happen to drive that price up. So that's where this strategy comes in, where you're buying a straddle. And if you want to reduce your risk, bring in premium by selling something up higher and selling down lower, the same thing will happen on both of these, but to a lesser extent. So instead of making $9, you may make $1.50 or $2. You will eat up a tremendous amount of your opportunity by doing that, but you'll also cut down how much risk you have. So this $75 will drop to $40 because you sold $35 in options up here. So when you were long calls, you sold the same amount up here. You were short, or your long puts, you sold puts below it. So the model that I was sharing with people is buying 1900s and selling 1950 and selling 1850, 50 points out. And then it came close to approaching those today. That'll eat up 2/3 to 3/4 of your profit, but it does give you some insurance, and it does reduce typically 40 to 50% of typically not more than 50%, but 35, 40% of the costs that you have to have outlaid. So depending on the size of your account, that may be a way to do both. Even with that, even if you made 2% in a day, on those days, and you can find these trades at least once a week. And in today's market, you're going to find them all the time. So we want to start talking about triangle trades in the chat room. We want to talk about opportunities for breakouts. So when we see triangles happening in areas that have high implied volatility, and if you look at it on your machine, typically it's going to be 65% or better. Some of those have implied volatilities over 100, but 65 to 85 or 90% implied volatility on a single-sided contract, a call or a put, is a great that means that that's something that's perhaps opportune that we should get into. I especially like those that are kind of in that 60 to 80%, because they will jump up even higher. When that implied volatility goes up during the market, when it breaks out of that triangle, you get paid for that extra volatility. So that's the strategy that I'd like for us to look at. Now I'm going to step over and we're going to actually go back into, I'm going to go back to the, to flow, and we're going to look at some of the charts that we have up and what those things are, so that you can actually take some of this stuff into practice pretty quickly. Let me pull up. And so for those of you most of you are not old enough, but while I'm pulling this up, I'm going to play a little something for you just so you can hear. Maybe you'll relate this. This is 1968. I'll be impressed if any of you can tell me why I'm playing this thing. It's called In-A-Gadda-Da-Vida. And it's done by a band called Iron Butterfly. So if you know people that served in Vietnam or anything like this, it was played a lot. That's In-A-Gadda-Da-Vida, but that's what I think of when I think of Iron Butterfly. Anyway, enough of that. Let's go to we're going to go to flow, and I'm going to share the flow screen with you. Let's see here. Oh, that is not. Hold on just a second. Let me try it again. There it is. Okay. Great, great. So I'm going to share this with you right now. We've got Bitcoin pulled up. I'm going to walk through a couple of these just because we were talking about gold earlier. I'm going to go to gold first. For those of you, if you don't know the symbols, you know, GC and what have you, just type in gold and you'll see the different symbols that trade, and they come from different markets. So COMEX, SafeX, VX. Typically, I trade a month up front. So we are beginning March. So I'm typically looking at April, just so that you know. If you're trading E-minis, they'll be almost identical, but you can look at the E-mini as QO versus QGC. I trade the big contracts typically, so that's the one that I use. But I want to share some things that are pretty interesting, and gold is going to be one of those. We've seen this pattern, right? And the 5-minute and things are not necessarily reflective of what happened in the market. The market is much stronger than what we're seeing on flow. This is showing a new high. This high is actually higher than the former high, so it's going up. One of the neat things you're going to see on the charts is right now where we predict out 40 periods, you see a price chart here. You're actually going to see, I'll pull this up so you can see the full size of the chart. And it shows, well, it shows not available markets closed, but let me see if I got another one here. Yeah, I'll pull up the hourly. So you're going to see on this hourly chart, widen it out a little so you can see it all. You're going to see on this hourly chart, you know, it shows you what 1936.99 is the price. It's going to drop down and come back up based on the oscillator. That's kind of telling you where it is. But I want to make sure that we're clear on something. That's taking you 40 periods from the close of today. And so every hour that's updating, and it's giving you 40 periods forward. We have the math that's built right now where it's going to actually give you the price at the bottom where it goes from flat to turning up. And it's going to give you the price at where it's going to go from top turning down. The good and the bad with that is, rather than having something in the middle, realizing it may not be quite to the top, or having it in the middle, not knowing where the top and the bottom are, this will be much more accurate. That being said, let me qualify it by saying it still is an oscillator. Flow is an oscillator, right? It gives you predictive value of pressure. And so pressure going up is not always the same as pressure going down, and so on and so forth. So it's really good at predicting which way things are going to go and where pressure is going to drive things. But price prediction may not be quite as accurate as your own price analysis. So you've got guys like Brendan and Ernie and others that are sharing, you know, their price targets. Those are probably more likely going to be accurate, but this gives you a little bit of an idea. When they sync, though, when they're very close to one another, that's golden. And I don't mean that as a pun necessarily, but that's really, really powerful. And I think we saw that today with nat gas, the predicted trends on flow 2 or 3 in a row. The slingshot was on, and it paid off really, really well. And so that's how we can combine a couple of things together, but using price action as your primary determinant of where you buy and sell and where you maintain stops and all that sort of thing is still there. You can see, though, over the next several hours, we look like gold's going to turn down, but it hasn't hit the high band. If it had, it would mean that 82% of all the forward data should go in the direction, which would be down. Gold has been pretty strong and maybe going to, you know, more historic highs, and some of those levels are real big gaps. So we have to be careful with gold in the short term. It's also the reason we don't look at one chart and trade one chart only. And I'm going to show you that in just a second. Why time series stacking is so important. And we use it not only for price action, looking at 5-minute, 15-minute, and hourly, but it's also good on flow to look at the longer term time frames, especially if you're an options trader. But if you're a swing trader or even a day trader, I really, really recommend that you look at all the time series so that you're cognizant of where the potential risks are. One of the things you'll note is that I pulled this chart out separate, and I can size it. It takes up the whole screen, and I can put all of these separately I can put all of these charts separate from the rest of the screen. So you can take charts now from Flow and click on them and cut and paste them to other parts of your screen and build your own custom screen. So I thought I'd share that. That's a really neat update that's occurred. Now, let's get back to gold. And you see on the hourly, it looks like it's going to drop in. On the 4 hour, it looks like it's going to drop in pretty sharply and then maybe bounce around. The bands go from medium distance to pretty wide, meaning there's likely going to be a bunch of volatility. And when I say a bunch of volatility, I mean from March 6th through April 6th or so. So from the first week of March until the first week of April, it's probably going to be very volatile, bouncing around a lot. And so we can expect that. We also know that the days for the next few days are going to trend down, and then you're going to have this sideways direction. And then it looks like on the daily, it's going to go up, come back, and trend up again on this daily chart. But what's really powerful is the weekly. Look at this. Oh my goodness. This is really, really something. If you look at this weekly chart, and what I'd like you to do, for those of you who've been trading for a while, if you're a new trader, just understand that while we're looking to short the 30,000 foot wins, the things that are really propelling things forward are going to continue. Things that are driving gold higher, those fundamentals are going to continue. If you are a longer term trader, you want to wait on that recession of gold price. You want to wait on this bottom down in here, and you want to buy options that are a month, 2, 3 months out. Probably this may happen in March or April. Around the 1st of April, middle of April, you may want to buy call options, out of the money call options or spreads, or you may want to use what we just talked about. You may want to use a straddle or even an iron butterfly to trade, because volatility is going to go from down and bouncing around sideways to exploding upward. Exploding upward. This is going to be really, really crazy. Not only will it go from exploding upward, so you're going to see this retrace back in here, somewhere into one of these support levels, probably back in here, a nice big down move. And then it's going to be like a rocket ship for a week or two. What I would ask you to do, I'd ask you to speculate a little bit. You're welcome to share it in the chat room. You're welcome to email it to me separately. If somebody gets it exactly right, I'll send you a hat and a t-shirt, Trade Oracle Group hat and t-shirt. What's going to cause that to happen? What's going to cause gold to have that kind of explosive up move? And it may have already begun. I have some ideas of my own, and I'll share them over the coming week. But as prices drop back down, people are going to become a little complacent. Volatility is going to narrow. This triangle pattern is being built. We made a lot of money today. This triangle pattern is being built on a weekly chart. We were basing it on a 60-minute chart. And so if this comes, now this is starting to break out, but when this is that explosion from outside of that triangle. So when it comes back in, there may be another opportunity, not only for it to break out, but for it to break out further and farther and longer than it has before. And then for the next several months, so from June, around the first week of June, until November, it's going to drop, 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 drop. That means we have a long-term trading strategy, and we can start doing calendar spreads and other things. And we'll talk about a whole new set of how to trade options and also how to trade those symbols. And what will end up coming into this is overnight trades and early market trades. And you want to be around for the slingshot technology. You want to be around for those early morning trades in gold futures. You could do nothing but trade gold the rest of the year, and that could be all you trade. So this is coming with a very specific bias. I traded gold for several years. I traded huge volume in gold. And so I have an interest in it, and I follow all the fundamentals behind it. And so that might be something of interest to you guys, or it may not. But I wanted to share it with you because you really don't fully appreciate what kind of volatility is getting ready to happen. When you see this hourly bottom or this daily bottom, and you know that at some point that weekly is going to explode, if you're in this at the right point and you let it go, there can be a lot of money made. And so one of the strategies we're going to talk about later, and we hear this, I talk about it on a regular basis, and we say all the time, and I'm trying to find those instances where I can share it. But you can enter a trade on one side and I can enter on the other and we can both make money. You can also enter a trade on the wrong side and you can still make money if you manage it right. You can also enter a great trade and make a little bit of money, and I can enter a mediocre trade and make a lot of money by managing it properly. So that comes with position sizing, interest, and then managing it, as we were talking about, as it moves throughout the trade, as it moves throughout the cycles, adding to it, subtracting from it, building in, building out, adding options, or whatever the case may be, can fix bad trades and can make exponentially more money when you realize that it's going in your direction. You can use what you've made as a hedge to increase your the opportunity for more and more gain. It can also keep you from hitting a target and selling everything you have and leaving, because of the momentum, leaving some on the table, and it keeps going and going and going. And you'll notice that some of the level 3 traders that are in the room now, those guys are really getting good at that. Rather than just selling everything at a target, they're selling some of it, 2/3 of it, and they're holding and holding. And in the past week or two, these guys have really been cashing in because they're seeing some trades go far and above. And normally where, for example, they may make $1,000, they may make $2,000 in the day just because one of those trades was extra volatile and they held part of it and made it and let it keep going. As long as the momentum was going, they stayed in that trade. So this is one of them, gold. So you want to keep gold on your target list. I'm going to add in, we're going to go to a couple of the basics, the S&P or the E-mini. And you can see that ES here has pretty good price action. And it looks like it's going to drop through and then we'll have a big rally later on. On the hourly, this is I want to bring up the hourly chart because this is kind of a W bottom. So we may see a little bit of a move up and then it may bounce up outside of the bands. And while the bands are narrow, it means two things. If it bounces up, it's going to bounce up quickly and then it's going to fall apart hard. So you may make a little bit if you're trading, you trade 1 or 2 contracts, but you want to be selling 3 or 5 when on the other side early chart. So by time series stacking, this looks like a great bullish chart. Look at these, the blue lines here look like it's going to rock and roll. So it could be a tremendous trade on E-mini coming up in the next day. This looks like it may, the 15-minute, the next time period up, it could go up a little bit, fall in, and then rocket back up. This trade could definitely fit inside of that trade. You have a triangle pattern in 15-minute, right? We keep seeing more and more of these happening now. It comes in, and so what's going to happen? It's not going to stay like this. It's going to come in a little bit, and what it's saying is it's going to take a big breath. It's going to probably come back into this support level, right? So if we see this happening, we see this dropping down, this may be below those 3. So it may drop in even further, and then it's going to rocket back, slingshot back the other way. And so now you have a triangle that's kind of going sideways. Here on the 30-minute, you see a triangle kind of going down. And that's probably why we're going to see more pressure. So that medium-term pressure is actually more bearish than the 15-minute pressure. So this may actually go up a little bit, right, to a resistance level here. Oh, excuse me. And then it may, then it may drop back down. I keep hitting the wrong button. And then it may drop back down harder and then rocket back up. So we're expecting increasing volatility. Anytime we see these triangles, we're looking for that volatility. And now you have a strategy as an options trader to be able to trade those. So in the E-mini, there's a reasonable chance that if this doesn't happen near the open, I will be buying a call and a put on both of these. And when they move to one side where one goes past the other, I'll stay in that. I don't know exactly which way would be the price, right? It may go way up. And if it does, then I may sell the trade out there. Then it goes way back down. It could fall out and I'll make my money there. But this is a good example of where taking both sides of the trade, using a straddle may be good. Otherwise, we're going to trade small on this long, even though it looks great, we're going to trade small because we still have the red line in the future on the hourly going down. We have the 4-hour turning over going down. And on the daily, while the daily is going up, the trend is still down. So there's a good chance it's going to make one more new low and then it's going to rally back up. Same thing with the weekly. It still has room to go. And we oftentimes see some of our biggest moves at the bottom. And we'll see that move maybe where it comes up, takes a breath, and then it falls apart hard. So we're watching for that. We're going to be careful for that. But in the S&P and all of the derivatives therein, we're looking really to make money on the next short side. let's look at 6A, and we can look at it as a couple different things. I'm actually going to look at Aussie dollar. So this is the micro. I'll do the back adjusted just because it may have more data in it. So this is the Aussie dollar. Some people call the 6A. This is an interesting too. We actually were looking at a short, but it's been slowly creeping up, slowly creeping up. It's actually been stronger on the 5-minute and even on the 15-minute. The 15-minute shows it going down, but the Aussie dollar actually has been going up a little bit. And what's interesting when you go back to price charts, and I'll pull up price charts in a minute, is when you see this kind of action happening, at some point, this trend will follow and it will catch up. And it may be, so we have to say, when is it going to happen? When is it going to fall apart? If we keep seeing the downturns, but the downturns don't really go down, it means that there's a stronger pressure, probably at a higher time frame that's drawing that. Well, the hourly is not that weak, and the hourly could actually continue going up. Theoretically, it has just as much chance of going up as it does going down. The 4-hour, however, looks like it's at the top, but it still may go up for several 4-hour periods, which means for a few days. There's a real possibility that what's going to happen is going to happen over this weekend, if not Monday. So we may see this move on around for several hours. We may see the Aussie dollar move on up. And when it gets to this far right side, watch it just fall off. And you have these huge moves, and Aussie dollar does that. And this is where you can literally put that risk on. And remember, these have patterns. That's the difference between this and other oscillators. A lot of oscillators seem to have patterns, but they really don't. This does, because it's millions of patterns built on top of patterns, built on top of patterns. So you're seeing series and series and series upon patterns. That's the real magic of flow. So when I see a high point here, 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 I'm expecting the next one, it may even go through the line, but come up to this blue line. That's one reason I think it might go to the blue line. I would love for it to go to the blue line here. Then I'll feel highly confident. I will give it a lot of room. If it extends, I don't care. I will give it a lot of room. I'll trade small because I'm expecting a huge move. I'll trade small, but I'm going to hold that puppy because it may rock and roll. And I'm expecting that Aussie dollar to drop through the floor. Right now, though, looking at this, that sounds like an easy strategy. But let's go to the actual pricing. I'm going to share the other. Let's go to the price to the. I'll use the trading view screen up. Hold on just a second. Sorry, I need to highlight that one. Let me get that screen up, and then we'll go to there. There we go. All right. So, and I have the Aussie dollar pulled up here. So while we keep seeing it turning over, this is on a 5-minute. I'll change the time frame to get more like what we were looking at. But even if we look at an hourly chart, we're looking at it to turn over, but it's been steadily going up for a while. And so we actually had looked at shorting it in here, and it came down a little bit and covered some, and then it went back up and shorted a little bit more, covered it on the open, and then began to short it again when it set what we thought was a lower high and got stopped out, did it again, I think right in here, because it goes to this, and got stopped out, got tired of waiting on it really, and got stopped out. And so, but when it does move, we make good money. So we're still green on Aussie dollar trading from one really good trade and one mediocre trade, because these others have been fairly small. But you can literally give this hundreds of points, and when it moves, it's dramatic, right? When this actually fell apart and it just went and went and went, it went from 72,815 all the way down to 985. That's huge, almost 1,900 points, massive, massive. So you can take a pretty significant amount of risk. And can you guys see my? Are you able to see my chart? Okay, great. Sorry about that. I'll make sure I wasn't stuck on that tab. But when this does turn over, that's the kind of move we can expect. So when this rolls over, we can expect something that could be 1,000 to 1,400 point move, maybe even more. And we'll actually walk out what those numbers are when you look at when we go to the 4-hour charts and the daily charts. But even if you look at the hourly, I'm going to scroll the hourly up here a little bit, tighten it up. You look at all this kind of sideways movement, steadily building up, falling apart. And now it's moving up at a faster angle. We're waiting on this to top. You now have kind of a double top here on Aussie dollar at 855 area. And if this creates essentially a head and shoulders, the first level down will be somewhere in this support level. I think everybody would agree. And the second target down would be almost, would be 60% more of that distance, down to the 0950 level, 0960 level. And so let's go back to this chart. Let me make sure that you guys are seeing my Aussie dollar shares thing. Make sure that you're on that chart. So when I look at the hourly chart, I'm waiting on this to top out. And most likely what will happen is when it tops out here, it'll also be top on, and the 5 may or may not be, but the 15 may be near a top, and the 30 will very likely be a top. So I look for the 60-minute. I'm waiting, being very patient. And it may be, like I said, Friday when that comes in. But when this starts to happen, when the hourly moves up and it gets to the far right side on that hourly, and this moves over, those of you who've listened to our training videos and whatever, you know that this here, this area is called an H-bomb. It looks like an H with a really long handle on it, right? That's an H-bomb. And it may actually drag out a little bit, and it can actually create kind of an inverted angle, triangle, what they call a wedge or widening wedge. And, but when it finally pops and it stays below this kind of shoulder region, when it finally pops, especially if it doesn't make a new high, you'll see that big move probably in one day. And so Aussie dollar, if you don't trade it, you need to keep really loose stops on it, and be patient for that entry when multiple moons are in alignment, when the 30 and the 60 tie in with the 4 hour and the daily, when you probably have 4 moons in alignment, and then enter small. Don't try to pay off the house in one trade, because it can move against you just in regular daily volatility. We put 50 pip stops on things, and that's really low. Some of these you need 180 pip stop, but you're looking to make 500 or 800 pips on some of the moves. Forex in flow does really well if you're swing trading it. If you're scalping it, it's a bit harder. You can still scalp as long as you're following price action first and using flow to kind of give you general guidance. But if you want to see really big moves and invest a small amount of money, this is the place to play. And we're going to see more and more of this triangle action where things condense for a while and then they explode in another direction. So you can keep that chart kind of at an angle. This hourly, kind of the same thing on the bottom, but it's probably going to shoot back up. So I'm actually looking for Aussie dollar to go back up. And however strong it is, if it goes through the former high, then the drop may stop at that first target, and I'll sell more of it. If it doesn't, if it goes all the way to the top and doesn't make it to that recent high, it means it's weak, right? So you have the former high that we looked at. If it goes back, if it goes all the way up and doesn't really break through that 72,860, even I'd say 72,900 even, if it doesn't go much past that, then I expect it to drop in hard, and a very high likelihood it's going to hit all the way down here, because that means it's generally seeing its weakness. If it goes past it, then my target, I'll probably sell 2/3 to 3/4 of what I have when it gets down to this 71,800 level or so. So I, based on how strong it is in here, will tell me where my target is down below. Excuse me, let's go back to back to our trading symbols. So that's Aussie dollar. And then we'll look at, you can type in the numbers if you know the numbers, or you can type in Euro EUR and it'll show you everything that's on there, right? So on the 5 minute, moves up and down. People can scalp out of this all the time. You have guys like Colin that was on a video last week. He literally in the mornings, he sees this uptrend, like he'll see this 15-minute uptrend, and every time it drops into a level, he'll buy it and sell it up, make $50, buy it, sell it, make it $50, and he'll make $300-400 just trading late in the evenings or early mornings or what have you doing that. But the bigger trades where he holds, a lot of that comes from trading off of the 30-minute and the hourly and looking for those things that are just going to trend for a long period of time. And so the hourly looks like it's going to trend up. The daily looks like it's trending up. All of these are getting ready. So if this comes down to a bottom on the 5, on the 15, on the 30, and this is kind of in the middle, but it's also near a support level. So it may not come to the blue line, but if this comes down a little bit to a support level and the hourly doesn't really change, it's kind of flat, it's already at the support level here, it means that you have some pretty decent opportunity in the euro dollar for it to really take off. So if you have, and when you go to, let's go to price chart so you can see, because there's a difference in what's happening in, I'll put the April's on here. Oh, you know what? I should use the continuous contract. There's a difference in what you're seeing in the euro and in the Aussie dollar, right? Works. I'll do the contract in front. There we go. So while the Aussie dollar we saw generally moving up and getting ready to roll over, the euro is actually weaker than that. So if you're looking for a big move and the big move happens to be down, then the euro would even be better because everything's turning down. But that's not the case. Here it's saying that it's going to stop here. This is a support level and it's actually going to bounce and go up. So in the euro dollar, while it's almost the inverse of the Aussie dollar, right? And but you have a series of lower high, lower high, lower high. And now you have a bottom, a double bottom. If this stops at the third time and starts moving up, what do we call that? That's a W bottom, right? So if it creates that W bottom, and we'll see sometimes the same pattern inside of another pattern. This is a W bottom. You went up, goes back up, comes to the bottom. This is a W, right? And then it can take off, go all the way back up into that same level, into that 1400, 14,000 level, 1.14. And so what we'd like to see is for this to stop and start to rally back up and go and set a higher low, then set a higher high. As soon as that sets a higher high, if we go back to our charts here, that's exactly what this is talking about, right? If this comes in and sets a higher low, and notice this is just a little bit higher on the 30-minute. I'm going to blow up that chart because I would probably signal off the 30-minute. I think the 30-minute chart is probably going to be the dominant one for the euro. So if it goes up, it may rally up a little bit more and then drop in. And if it drops in and sets a higher low, comes close to this area, that's going to be a real opportunity. And while this shows 11.27 and this shows 11.5938, you know, it shows 40 something primary pips. That's good, but I tend to think that it'll be more, but I also think it's going to keep working its way up. And when you go to the longer term charts and you see the 60, your resistance level is really going to be up in here, where this basically saying it's going to stop. I would expect the pattern, right? I want to see the 30-minute pattern fit inside of the 60-minute pattern. So I saw these highs, lower high, lower high, lower high, lower low, lower low, lower low. I expect this to maybe set a higher high, come back in, set a low, maybe a lower low. But this lower low will be higher than it was before still. So when it finally bounces down, maybe a couple of times, and it hits that low, and that low is higher than this one, it's going to explode back the other way. It's going to replicate that pattern. It's going to go back up to this resistance level. It's going to come back in. And it's going to go back up to the next resistance level. Then it's going to come back in. It's going to go back up to the next resistance level, somewhere in here, come back in, and then it may really, really explode after that. And we'll see. Remember, one of the great things with flow is it's dynamic. So as that data comes in, these charts may narrow and steepen on the 15-minute especially, and on the 5-minute especially. And if they do, then you can feel even more confident in staying in those last pieces. So if you buy 3 micro, like $10,000 contracts, if you're buying those and you buy 1 and you sell it, and then you buy 2 when it comes back again, and you sell 1, comes back, you buy another one. So now you're 2, comes back, goes up. When it comes back and it looks like it may break through here, then you buy 2 more. So you're now long 3. And that's how you build into that trade right before that explosive breakthrough. And if you're doing that, if you're following that on anything, futures, options, equities, what have you, please feel free to reach out and call me, or reach out, not call me directly because that'll be tough, but put it on the Discord trading room. Share it in a text through there. You can send a message, I think, through there, but certainly put it on the room and ask a question. And you're welcome to direct it to me as well. It will notify me, even if I'm in another country. I'll get a little signal, and as soon as I have the ability to look at it, I'll do that. I want to make sure that I respond as quickly as I can. So we've covered kind of the gold. We covered S&P. We covered Aussie dollar and euro dollar. I'm going to cover a couple of stocks here real quickly that other folks have put up. So one of those that I don't keep up that often, but I probably should put it back on because it's a great options stock as well, is Apple. And Apple may be too volatile for some people, but I can see why folks asked about it, because there's some crazy lines. When we look at flow, and this is why you get addicted to it, until you don't have it for a while and you realize, oh my gosh, I forgot to look at flow. I'd really want to know what it says is going to happen. We have kind of the same thing. We had an inverted wedge. It got wider, tightened up. And now somebody says, well, gosh, what's going to happen? Is it going to break up or break down? Well, the medium term says it's going to go up. The down move, it does look like it's going to take a big breath and then it's going to rocket up, right? That's the way that I interpret this. I interpret it's going to go down to a support level. It kind of has a rounded bottom here. I expect it to go to a little bit higher level here. And then I expect the move up to be much bigger than the move down. So while I like this could actually happen in the morning where it gaps down. And if it does, that's what we would call a fade trade, right? I'm going to fade this. If it gaps down, I would buy it. And I would look to just rock and roll, because this is 82% of data should be in that narrow space. That's a highly, highly probable trade. And on the way back down, same thing. That's huge. So you can make money on both sides. So what do? Trade small, trade fast. You want to build it in, sell out one where you think the target is, hold the other. And as soon as it slows down, sell that one as well. If it's at a resistance, put the first one at a resistance level, probably at a high resistance level. We'll look at that on the price chart in a minute. That's what I see off the 5. I see that potentially happening off the 15. I see another move just like this one, like we saw on the 15. The 30 could drop all the way down. It would have a big move, come back, move up. You'll have 2 or 3 moves over the course of tomorrow and the next day, probably into Friday, where Apple has those big rallies. But when I look at the 4-hour, I see that happening, right? I can see it bounce back up. But then in a few days, and this is already turning over, but in a few days, it looks like it's going to fall apart. So can all of these build into that? Yeah, you can have another. This becomes a wedge, right? It goes up to a new high up here, breaks through the blue line, and then it falls apart. So I can see all of these patterns fitting in. The one that gets tough is this daily. I can see this falling apart and going back to that former low. So I can see this breaking up a little bit to, I can see Apple looking at the daily chart. I can see Apple moving up, breaking down into a higher low, and then ripping back up into this area, right? But it's saying soon after that, it's going to fall apart. This may be early. It may drag on for several hours. Remember, a 4-hour chart is half of a daily. So this could be that this is squeezed together a little bit and the daily is moving. So I would give it room, certainly, and let it go. Once it gets in that middle area, though, if it goes sideways, this is another opportunity perhaps for that trade we talked about today, to either buy a straddle or put on an iron butterfly. So we'll watch this. But right now, I'm looking to fade that early morning trade. And I want to be careful because this 4-hour does look weak and it could go down and down and down. If it breaks through, it may have 1 or 2 support levels. I'm going to find out what those are. I'll buy 1 or 2 of them, wait for the gap and sell it. If they fail or it comes back and slows down below its first major resistance level, I'm selling the whole trade. I'm getting out of it, right? Because it means that the overlapping, the overarching trend is still down. Everything else looks like this could happen. This pattern looks like a inverted head and shoulders, comes down, has the kind of a W bottom. It's forming a shoulder and it could rip all the way back up. So I like fading this trade. I like to see a shoulder come down a little further and buy that gap. All of those look like this could be a trade on both sides. So that's Apple. So before we go to something else, let's switch over to the Apple chart and look at it so we're not skipping around too much here. Okay, so we can see a little bit of that widening wedge, right, on an hourly chart. Let's go to a little bit shorter term. Well, let's actually, while we're on this, so can we see this dropping in a little bit, ripping back up to a big high, right? This is bigger and bigger and bigger, and now we can see it going all the way back up with a target in the 166 range. And so I can see it dropping back down. You know, it may gap all the way down to the support level in the 162 range. It could drop in a dollar and then rip back up to 166, go up $4 tomorrow. That's a very real opportunity. I would expect that's the pattern I would expect to happen. And I'm looking for it to not do that. And then when it falls off, because this is flattening, right? You got high, high, high. It's trying to break through that. It really didn't. If it fails again and it doesn't really get past that, or it only goes a little higher and it just has that wedge, and our technology flow is saying that it's going to fall apart, you have a price point that's more than 12 points below. That's a nice trade. It's a very nice trade. So you do have an EMA crossover, but I imagine that's going to cross back over tomorrow or the next day. So that's where Apple is. A good trade, but don't forget the opportunity on the short side. So I literally would be buying that bounce as it goes back up. I would hold it, hold it, hold it. And as I hold it, I'm probably selling a call spread, or I'm buying a straddle. Because if it rips and it goes back up, it's going to jump up. It could go up in here at least another $5, but it could drop 10 or 12. So I would price it based on that. We can talk about what that strategy is. We'll determine it as we watch it real time in the chat room. Okay, let's go back to and we had I'm going to skip around a little bit. We had X, which I do trade U.S. steel, and I trade it fairly often. Bands are wide, so it means things are just kind of bouncing around. On the 30-minute, kind of bouncing around. On the hourly, my concern on the hourly is the bands are getting wider. I'd like to see them getting narrower. It is trending down and getting flat. Certainly on the 4-hour, it looks like it's going to fall apart, and then it's going to slowly move back up. On the weekly, can this fit inside of that? Yeah, it could fit inside of it. It could drop back in and then it goes back up. Same thing. If you see this on a 4-hour chart where it drops back in and then goes back up, if the price is enough, it's got an increasing wedge, right? Little bounce, bigger bounce, and now what's expected is a larger bounce even than that. So when we have increasing volatility, the only negative to this is that when you have that wedge that's inverted, where it's getting wider and wider, the volatility and the implied volatility, the Vega as well, are all increasing. So you may not get a lot of extra premium if you're buying an option expecting to sell it. You're going to get implied volatility increase when the price changes, but you may not get a lot of extra volatility increases because it may be so high. It'll only come from the natural movement of the underlying. So I do like it. I wouldn't trade it quite as big, but I would potentially put on a straddle. Why would I do a straddle? Because it could break way up before it breaks down. I could be wrong and it goes way up. And if it does, I'll sell it, or at least sell one side of it, and then let the other side come in. So this is a little bit different. If the weekly was also falling apart, I would feel even better about it. And I would trade just one side of it, right? Rather than trading a straddle, I would just do I would probably buy an at the money put and sell a way out of the money put to hedge it and to reduce my margin and to reduce my risk. So that's Apple, or excuse me, that's US Steel. And then you want to do your underlying look and your underlying research on steel and say, well, why would steel be going down in price right now? And so I like to go back, and I think you can find that there may be, when you look at the countries that manufacture steel, the ones that are buying steel, import and export, what kind of news might come out in the next day or two to drive this down? Or is it strictly just price action, technical? That may be it. If there's no news, then it's just technical. And then it's going to go back up. And the reason it's going to go back up is just common sense. For the next few weeks is a lot of stuff, steel is sent to places like China. They modify and improve the steel and then send it back. And of course, the quality is not as good, but they are huge in volume and low in price. just like many, many other things. So building and construction all over the world. What could cause this to go down? Interest rates go up. People think building is going to slow down, right? So it drives steel prices down. Then something happens to improve access. There's all sorts of things, but I would expect that this long-term piece will likely come from news. I would expect the weekly piece where it drops over a period of time to come from news. And that may actually be the opposite, right? If I see this weekly, I'm going to pull this up just so you can see, so that we can say that we talked about it when you see it happen. What very well may happen is when you see steel prices dropping like this for a period of time, what does that mean? Either some resolution has come with China, and we're not quite as worried about trade with China. It means that interest rates have been dropped, that we have easing rather than tightening. Something happens where interest rates are changed so that housing can continue, or some report comes out saying that supplies are improving and construction is on par and on pace, and there's no struggle or what have you to get the inputs, then the price is steadily going to drop for a while. So when this happens over the course of a few weeks, that's normally going to be news driven. Let's go back and look at, let's just look at one more. Actually, I'll go to the chart. I didn't go to the chart yet on X. So we'll go to this deal. Wow. So there's US Steel. One of the things I do like to do with US Steel is I do trade options on US Steel pretty regularly. And this is kind of that U bottom. And so we were talking about, is it going to stop at the top and go down instead of lower high or what have you? But this pattern is similar to what we saw there. But look at that move up from 22 to over 28, $6. I mean, that's almost a 30% move in a very short period of time, in a week or so. So that's massive, massive. So volatility increased, premiums increased, and so on and so forth. Once this narrows for a little bit, it would be nice, and we might be able to do the other side of it. And it may be as simple as buying out of the money options. If you want to buy a put and a call just to be square, you can probably make sure that at least 50% of the money you put out, 40 to 50% of the money you put out, you're going to recapture within a week, because something's going to happen, and you're going to be able to cover those dollars. And so we want to look at the volatility on that. So if I'm trading it and it's sitting in the middle, it goes up, comes back, and it's sitting at 27.50, for example, and I buy a 27.50 put option, and I buy a 27.50 call option, and I buy that for, say, an April expiration, a late April expiration. So it gives me 6 weeks. Yeah, something like that. Say 6 weeks, 42 days, something along those lines. And which is very possible to have happen. And so I buy that at 250 on either side, 250 and 250. I spend $5. Well, that means that if it goes from 27.50, I don't break even until it's at 22.50. Right? That's really tough. That's really tough. It may not be $5, it may be $3, but I would expect it's going to be $3 or $3.50. So if I buy both of those together and I spend $3.50, you go, well, gosh, it's got to go to 24 to this major first level support for me to break even. That's not actually the case though with Straddles. Remember that implied volatility. When you buy it, all the money you paid is implied volatility. It's theta. You're paying for time because it's at the price you're buying it at. So all of that's implied. So that's on top of it, right? So if it's $1.75 either way, and it drops in to 25, it's actually, say it drops into 24.50, which is $3, and you needed to make 3.50. Well, it dropped in 3, that's one, but you still have $1.75 in premium, plus maybe decreased by a day or two, plus it increased in volatility. So it may be more. So there's a decent chance it's going to go up $1.90 or $2. So while you say, gosh, it drops in here to be even, that's not the way the options works though, because the theta is still there and the theta decay. So if you take 42 and you lose 1 or 2 days, it may drop a little bit, 10 cents, 15 cents, but you're going to gain. But by the time it moves down here, you still got that. So, and likely more because the volatility, like I said, increased. So you may be able to close it out and make $1.80 to $2, $2.20 on that trade just by it hitting that first target. And so you say, well, why don't I just short the stock at 27.50? And, you know, if it goes to 24.50, I made $3. Well, one is you have a lot of margin for that. And you'll have half the margin by putting on the straddle. And the other is if you happen to be wrong and it does explode up at one way, you can get out of it and then re-enter it again. And this is one of those trades where if you're wrong, right, this is kind of that increasing wedge. It comes down, goes up, has a move that's further down, and has a move that's further up. If it happens to explode further up another level or two, you actually make money being wrong. So if it has an explosive move up or down, there's a chance you can sell it for more than what you paid for it, regardless of which direction it made. So while straddles take money, it may be it's a good strategy for this day and time where volatilities are in the middle and expanding on a regular basis, expanding and contracting. But even when they contract, they're in that middle level. So that's kind of how I would look at US Steel. We're 2 hours into this, so I'm gonna stop here because it's been such a long chat, and I really would like to start getting things where they're a little bit shorter. But this isn't really to go out on YouTube and get a lot of people to watch it. This is for our team and our people to have strategies for the next couple of weeks. So I'm hoping that there's some value in here. Anything that you see along this, whether it's wedges. Remember, wedges already have increasing volatility, so more implied volatility is built in options. Decreasing or triangles have volatility decreasing, so there's an opportunity to make even more when it explodes. So that pattern would be better than this pattern, right? Those are kind of the messages I want you to take home. So look for those decreasing channels where the longer term, the hourly, the 4 hour, look like there's going to be an explosive move over the next few days. And if you're wrong by a few days, that's okay. Don't buy options that are going to expire in the next 7 days using this strategy. You always want them really 28 days or to 48 days so that you can take advantage of that and not get stuck in a trade. Because what happens, people trade the options expiry. So they'll actually let it crash to their target point and then they'll move it after that. And that's a little bit more advanced where we talk about block trading at volume and options trading, matching blocks and so on and so forth. That's a whole nother level. You don't need it. You can make millions of dollars a year without having to get into all those technicals. Just stick simply to looking for triangles, using flow to find where you have high prediction of big moves, and in markets where those markets are also going to move. So whether it's energy or metals, or what have you, tech, and where the expectation is that market is starting to contract after big volatility, something else is going to set it off, and you buy that bait and throw it out before the fish are released from the cage, and watch it happen. Thank you so much for being part of this. Again, I know this is a long day. I hope the value was there, and I quite frankly, I feel like if you use these strategies, whether it's just to find the trade to go in the underlying futures or what have you, the next couple of months can make your year. I expect that they will make my year. It may continue all the way through November, December. You saw some of those weekly charts. If we went back to the some of the stuff we saw in ES, we saw in oil, some of these others where if you look on the weekly charts, there's just going to be massive changes. Not only are they going to fall way off, but then they're going to have huge rallies back up. So this whole year and through November could be really, really exciting, but we want to make sure that we've got strategies in place to take advantage of that volatility. So we're looking for, I'm going to try to cover a little bit of a strategy for the next couple of weeks. And then I'm also going to talk about money management so you can learn how to, when they make really, really big moves, you don't cut yourself off. So how to get out of it when it goes against you and how to hold on to the winner when it doesn't. So thank you very much, guys. Thanks, Brendan. If any of you guys have anything else, please put it on Discord. Please invite other people to check the flow out. And we're going to start trying to open up the chat room to more and more people. Thank you very much. I appreciate you all being here, and I'll stop the recording now and we'll go. Have a great afternoon. See you.